on board then, Sridhar Sivaram, Investment Director at Enam Holdings, right here in the studio. Sridhar, a very happy new year. You've been globe-trotting yet again. Tell us about the Masai Mara trip. Everyone's fascinated by the pictures at ET now.
I know, amazing trip. It's always good to recharge your batteries going into the nature and enjoying the wildlife. So it was a good 10 days in the Masai Mara.
Wow,
and it's
fascinating.
Always amazing to see.
The pictures on the screen, just absolutely fascinating. What stood out? I mean, I know it's a problem of plenty there.
I know. I think we got a live cheetah kill and then a leopard's meeting, which normally is very rare. They're very shy animals. And just the beauty of the place. We also went to a place called Amboseli, which is on the banks of, next to Mount Kilimanjaro. And you get elephants with the Kilimanjaro backdrop. Wow. It's so unreal. So I think it was a great, all recharged for 2020 now.
Yeah. Is it going to be well worth the ride, or is it going to be just that testing your patience kind of game for the markets like 2019 was?
I think 2020, at least that's my broad view, that we'll see the broader market rally in 2020. It can't be just the 15, 20 stocks taking the market up. We will see the broader market because a lot of them are now reached the value zone where you're seeing first signs of green shoots as far as their own businesses are concerned. So it may the rewards may not be immediate, but whenever you get the rewards, I think they'll be very fruitful. So that's what we are hoping. So we're looking at opportunities outside the 15-20 that most people have invested, including us for 2020.
I'll come to those 15-20 in just a bit. But do you think because of the US-Iran situation and the way you are seeing oil flying through the roof, it's going to impact us? You're seeing that bit of a shake-off in equity markets also. And you don't know how these kind of situations typically pan out. What could be the, the kind of intent that they're going to hit equity markets with. Do you think that could perhaps put a bit of a speed breaker in this mid-cap rally that you're hoping for?
It could. But if I just go back in the last 4 years and see all the tantrums that Trump has had with various countries, including North Korea and many of the others, they've had limited impact as far as the markets are concerned because none of them actually really escalated. Keep in mind that this is an election year for the US markets. Yeah. They can't afford too many large negative news. So I would assume that these are the normal tantrums that you see just before election as far as US is concerned. We've seen this playbook before also, and we are seeing it again. I hope that it is restricted and limited for the sake of everybody's good. Yeah. And hopefully, if there are any shocks in the market, I'm sure it'll absorb. We already have so many shocks with all the negative data that we have. So I think we are not short of negative news. I think markets will climb the wall of worries.
Yeah. But how are you explaining, that dichotomy that we're seeing? Exports have been stagnant, sharp rise in the import bill, now the strain on the fiscal deficit. Everyone's like, but what's going on with the markets? Because that's reflecting a very different story.
Yeah, so as I said, the market's reflecting a different story as far as the top 20 stocks are concerned. And you look at the broader market, many of them are, so we were looking at, the overall, 2,000-3,000 stocks that broadly trade. I think more than 50% of the stocks are down 60-65% from their peak. So there is the story of 20 stocks or maybe 50 stocks. And then there's a story of 2,000 stocks. So I think what we are trying to analyze is there opportunity in the 2,000? Not all of them are investable. And if they are collateral damage to things which were not in their control, and markets have been very punishing. If you see, even the slightest of bad news, even good stocks. We saw many of the auto stocks correct 50% last year. Some of them have recovered, but that's the extent of damage that we've seen to sectors if there is some sort of a negative news. So I think sanity will prevail. That's a broad view. And we are looking for opportunities in this part. Not to say that we are abandoning what has already done well, but in cases where we think there is irrational exuberance of valuation, we are looking for opportunities outside those.
Fair point. But just talking about that irrational exuberance in those 15-20 odd names, are you worried about the extent of damage they could feel? not just because they're going to fall under their own weight, which is also your concern as well, but I think somewhere the market seems to be sort of undermining the impact of reflation, if you call it that, because the bond markets are not really pricing it right now.
Correct. So see, whether they correct significantly or not, we could see a time correction for all you know. And that's our base case, that we may not see significant correction unless there is a bad news or significant bad news in many of them. If not, they could just see a time correction, and it could be that some of the the leaders for the next rally may be something completely different, maybe some other sector, maybe some other group of stocks. So it need not be the same. That's a broad view, that if something has worked for the last 4-5 years, I'm not saying that it cannot continue to work, but our broad view is there are more opportunities outside these, and that's what we are trying to explore right now.
Yeah, sure. In the past decade, if you stuck by with the financials and the leaders, you're in a happy place. FMCG for that matter as well. You stick by with the leaders and you've always made it good. What's the next decade going to be? Is it going to belong to a sector, or is it going to be those stock-specific mid-cap hunts that you may be working on right now or already buying that are going to make you money?
But actually, if you look at the performers of last decade, they're all over. So yes, financials have done, many consumer-related stocks have done well.
But if you stuck by with the theme of financialization, consumption,
so I
you're in a
don't
good
think
spot.
that changes. So if you ask me, good financials, good banks, will they continue to return? I think the answer is yes, because maybe this decade is even better than the previous decade, because if you look at the competitive landscape now versus say the previous decade, where PSUs were fairly large and they were growing to where they are now, and you look at some of the other participants, say the NBFC, the HFC, they all having their own set of issues, I think good private sector banks will continue to do well. And India is still sort of an underpenetrated as far as credit market is concerned. When you compare per capita of India and you see the percentage of household loans, they're still well below where many of them others were at the same 2000 per capita. So I think there's enough room for that that segment to grow. So I don't see any issues with financials as long as they find means to raise capital, I think, which is the most important point.
But the scenario which you're talking about, where consolidation will happen, when disruption happens, one player gets large market share, it's visible in HUL, it's visible in Bajaj Finance, it's visible in DLF. Some would say that market's already pricing that in, because large cap stocks is where all the honeymoon is, large cap stocks is where all the price action is. So what may play out as an economic reality in this current decade, our market's already pricing that in the run-up to the decade.
So even you named HUL, but we had Patanjali from nowhere came and grossed up 10,000 crores of revenue in 5 years. So I think in situations like where we are right now, where there's so much of disruption happening, I wouldn't take it for granted, even for financials. I mean, I think the next 10 years will see more disruption than what we saw in the previous 10 years. So as much as I said that financials will do well, but would I want to keep my eyes closed? And the previous philosophy was buy a good company and just sleep. I don't think in today's scenario I can really do that, because there's so much disruption that is happening, and we could see some new technology, some new way of doing things. I mean, just look at, did we know about Uber or Airbnb in the previous decade? WhatsApp was not there, Facebook was not there. The way advertisement today happens. So I think it's the next 10 years are going to be very challenging for even stock pickers.
So some would say that, look, whatever action is happening in the private domain. The private domain is dominated by either HNI investors or by P investors. A normal Aam Aadmi in India cannot participate in the private domain. Technology will change the way how we've done business versus we will do business. There are no two ways about it. But what we need to address here on this forum is that how can an individual investor plan his life or her life at a time when we are staring at a lot of disruption?
So I think because of these technology changes, the listed companies are not immune. So let's take financials and payments. Yeah. Look at the way payments have got disrupted or still getting disrupted.
UPI
because
is a
of
success
UPI.
Story. Yeah.
And look at how China has evolved. They have similar things to UPI and look at how they have evolved. The card usage is almost negligible there. People just use their phones. Now, do I think that similar situation will happen in India? Very much so. It is going to happen. We're already seeing the changes as we know, as we are seeing on the ground. Now, will that affect financials? Yes, it will. The question is who is fast enough to adopt? I don't know today, but I have to keep a close eye. So, which is why I said that there will be disruptions as in the next decade, and more than what we saw in the previous decade. Every listed company will get disrupted, and people who disrupt themselves will probably succeed more than people who are sitting on their glories and thinking that they can't be disrupted. I mean, that's my broad philosophy, I can say.
The ones who move with the times.
Exactly.
No, I mean, we think about it, but I was talking to somebody in Tata Steel and he said, okay, we are a boring business, but look at what we are also changing in a manufacturing process. We are changing a manufacturing business. It may not be that visible, but we are also changing. Okay, Sridhar, the house which you represent right now is known for buying metals, cement, classic old economy businesses. Old economy businesses, the businesses which have been built to last and which in a sense have played a very large role to play in India's growth. What happens to cement, steel, these classic B2B businesses which markets do not value them? If at all disruption will happen, they'll be the first one to hit or get affected because they are too large to move now, and that's where change is going to be difficult.
Yeah, so the only point I would make is that at the end of the day, whatever disruptions may happen, if infrastructure is going to get built in India and outside, even for that matter, if you look at reports from the US infrastructure they need massive infrastructure building as far as US is concerned. So I'm just trying to highlight that whatever disruption may happen, the real economy stuff still has to be built. Somebody has to make the steel, somebody has to make the cement, somebody has to construct the bridges. I don't think those changes, it is just the technology by which you do this may change, which may ease the way you produce, or there may be better alternatives available. But these real economy stuff will stay there. And if you ask me, typically from a valuation standpoint, they look very attractive. I mean, typically in the past, you've seen that anything between half to 0.7 book is a good time to enter many of them. And they are cyclical. So you may have to sit on them for possibly a year, maybe sometime 2 years. But the returns are disproportionate.
We'll get that data out. We're discussing this data on Friday itself, that what are the prices for metal stocks. I mean, learn from old timers like you. So I'll give you credit to some of the old timers. But we'll get the data out just for the benefit of our viewers.
No, but that's the broad philosophy that in downturn, you don't look at earnings and EBITDA. And what you look at is how is the price to book. And if that sort of matches this sort of a range, then over a period, they do give disproportionate returns. So you need patience, as I said. You need patience for this. If you have enough patience, and I mean, stocks can correct 20-30% even from here, for all you know, if there is some slowdown. But eventually, they do pay off. That's my broad view.
Do you think, in all fairness, market is aligning itself with the economic headlines? Or do you think that adjustment is yet to happen?
No, I don't think the markets. I mean, if somebody were to tell me, say, 2-3 years back that GDP will be 4.5%, inflation is heading higher, our current account deficit is moving higher, exports are not growing, I wouldn't have predicted this sort of index number. So obviously it is not aligning. This is also a combination of global liquidity, domestic liquidity, and many other factors that we have seen. But having said that, if you see over a longer period of time, markets do reflect the ground realities of the economy. So you could see irrational exuberance for a period, but not for very long period of time. So eventually it will settle in. And from whatever we hear that the government is now very seriously looking at the economy, they are reaching out to industry participants, to many other players to get feedback. I'm reasonably hopeful that the government has taken some steps. I mean, if somebody would have asked me a wish list of what the government should do, privatization would surely have been one of the top agenda, which they have done. Tax cut would have been a top agenda, which they have done. It's unfortunate that it has come maybe a bit too late. And possibly there are other economic factors which have affected, including the whole NBFC crisis and how that has affected the broader economy. So I think if a lot of them are addressed, maybe in 12 to 18 months, we'll have a different picture.
constantly been maintaining that it's not an NBFC crisis, it's a housing finance company
Yes, I
crisis,
still maintain.
largely
Yes.
due to real estate. So what needs to be done? How has the story panned out right now? Are we out of the woods? And, you've been talking about more stringent disclosures.
Yeah, but if I look at the problem even today is the real estate and the unsold inventory. So the last number of unsold inventory is anywhere between 1.5 to say 2 lakh crores. So in my view, government has a great scheme which is the Pradhan Mantri Awas Yojana, but however it has just not taken off. As I've shown in the past with data that I've collected, that only about 20-25% of people are actually claiming the subsidy. In my view, the government just needs to simplify. Just give a 5% subvention to anybody who buys a house, maybe for a year. And 5% subvention is a lot, but it may cost government only say 25-30,000 crores a year. So it's not that, because the total housing loan is only about 5 lakh crores a year. So you're talking of 5% is not that much. So if you're able to use that to liquidate the inventory, the whole cycle starts, because once real estate is linked to the larger economy and it has sort of a cascading impact on many of the other sectors, steel, cement, employment. I think the government needs to think out of the box. I'm just giving you a random example of what I think, because they already have a scheme which is not working. And maybe it's not working because there are too many restrictions in that, and not everybody is able to claim. And people are not even thinking that, oh, the government is giving 5% subsidy. But suppose tomorrow the government told me I'll give you 5% subsidy. I may, even if I have a house, I may think, hey, it may not be a bad idea. I mean, that may help to liquidate.
Sure.
So it's just ways of solving a problem which has been there for almost 5 years now. We keep talking about real estate as an issue. It's still not resolved. So hopefully something will be done.
And the multiplier effect that it has.
Very
like
much.
you said.
Yeah, I agree.
Okay. When we started the decade, financials accounted for nearly 27-28% of the weightage. Today that number sits at 40.
Yes.
I've not included insurance in it. I've not included a large AMC in it. Somebody will be part of the index in the next 4-5 years. Insurance could come as high as early as the next 6 months. When any sector has a 40-45% representation on the Nifty, that's not beginning of a trend, that's end of a trend.
Yeah.
Is that the biggest challenge for financials? That are we in for a decade of underperformance for financials?
Or let me put it this way, that we would see the leaders emerging from other segments also. So it is not necessarily that financials will be the only one leading the whole charge, which is what we've seen. But keep in mind that even in this decade, we've seen major issues with financials.
Yeah.
So it wasn't as if financials was always 40. They were possibly 30, 35 at one point. They went to 25 and now they're back to 40. So they've seen their own sets of challenges. I think those challenges will remain for financials. But I think, as I said in the beginning, that I think the broader market will also rally, is our broad view. That as the economy starts to recover, we are at 4.5% GDP. Even a delta of say 100 basis points can have a significant impact on the broader economy. So that's a broad view, that as the economy recovers from here, we would see other segments participate, maybe autos, maybe consumption, maybe exports may start to grow, maybe IT will come back. I mean, many of them could play a part in ensuring that finances don't go out of hand as far as the index is concerned.
So tell us what's next. The mountain gorillas in Rwanda.
So the checklist is huge. I mean, there's so many places to visit. So let's see. Hopefully, going around India itself is quite a bit.
We look forward to the photographs.
Sure, very
Thank
much.
you so much
Thank
for
you.
coming by in our studios and sharing with us your outlook on the markets.